Artificial intelligence is reshaping equity markets, but it's also making them more volatile and harder to navigate. After several years of strong AI-driven gains, U.S. technology stocks are now experiencing higher volatility. Investors are reassessing stretched valuations, the scale of AI-related capital spending, and how quickly that investment can realistically translate into earnings. Despite this near-term uncertainty, we continue to see AI as a long-term structural growth driver for equity markets. Technology remains one of the primary beneficiaries of the AI investment cycle. Large-scale build-outs in data centers, semiconductors, and cloud infrastructure are supporting sustained earnings growth, and that trend is expected to continue into 2026. However, the path forward is unlikely to be smooth. Markets are increasingly focused on return on investment for AI spending, potential margin pressure from heavy capital expenditures, and disruption risk within software as AI-native competitors emerge. As a result, volatility and performance dispersion within the sector are expected to remain elevated. Even so, underlying demand signals remain strong. AI adoption is broadening across industries, and the need for computing power continues to accelerate, supporting long-term growth in the ecosystem. Beyond traditional technology, communication services have also emerged as a key AI beneficiary. Digital platforms and search companies are increasingly monetizing AI through improved targeting, personalization, and engagement, which translates into stronger advertising efficiency and revenue growth. AI is also reshaping content creation and distribution. In entertainment and media, it is improving production efficiency, reducing costs in areas like editing, visual effects, and content generation while increasing output speed and scalability. Importantly, despite strong performance over the past few years, valuations in communication services remain broadly in line with historical norms, suggesting continued room for earnings-driven returns rather than purely multiple expansion. At the same time, utilities are playing a more structural role in the AI investment theme than in previous cycles. The rapid expansion of AI data centers is driving a meaningful increase in electricity demand, creating a long-term growth tailwind for the sector. What makes utilities particularly relevant in a portfolio context is not just growth, but behavior. The sector remains relatively low in correlation to both technology and communication services, and its regulated cash flow-driven structure provides more defensive characteristics during periods of market volatility. From a portfolio construction perspective, this matters. The challenge for investors today is not whether AI is a long-term opportunity, but how to stay invested through cycles of volatility while managing risk. Technology and communication services are likely to remain the primary beneficiaries of the AI transformation, but their returns are unlikely to be linear, and periods of drawdown or rotation should be expected. In that environment, combining AI-linked growth exposure with more defensive allocations such as utilities may help smooth volatility, improve diversification, and enhance risk-adjusted returns over time. AI is not just reshaping growth expectations, it's reshaping volatility. And in this market, the real advantage is not just participating in the upside, but doing so with resilience through the cycle.